Let's turn to the broader markets this morning. Our next guest does say this recent volatility is, quote, not a blip, and cautions that it might be too soon to jump back in. Joining us this morning, Stifel's chief equity strategist, Barry Bannister. Barry, great to see you again. Good morning.
Good to see you, Carl.
Your caution lately, especially when we were hovering near all-time highs, has been well-founded, although what makes you convinced that there is more to go on the downside?
Well, yeah, we had said that there would be a correction of about 10% down to the 200-day moving average. The NASDAQ 100 with its higher beta would obviously fall by a larger percentage. You know, it's funny, there's the Goldilocks and the three bears. I think the market not only believes in Goldilocks, but it thinks the three bears are an extinct species. You know, we see second half GDP substantially weaker, not just some scaling back on the consumption side, but fixed asset investment and net exports are going to be a disappointment. We also think the inflation's a little stickier than people expect on a year-to-year basis, and the Fed is cognizant of that. Their mean target for core PCE this year for the full year is 2.8, but we think it's actually closer to 3 by the fourth quarter. On a year-over-year basis, particularly supercore and sticky housing. We will see, but it's mostly the economy slowing that concerns us.
Right. Now, you've argued for S&P 5K by October, I believe, yes?
Yes.
Does that, if we get there, do you nibble, do you gorge, or do you wait?
We'd still be fairly expensive at that point. You know, brokers love bull markets. It sells stock. The market's naturally manic depressive, you know, Gustav Le Bon, De La Vega kind of things. Just it swings from one extreme to the other. But the market is still very expensive. And if you look at things like the futures rate cuts that are embedded on expectations, that would guarantee by 2025 into 26 a huge rebound in housing. Mortgage-backed spreads, treasuries to treasuries would collapse down to a normal level, and the 10-year yield would be much lower. If that happens, you're going to have more inflationary pressure, not just with the structural shortage of labor, the pushback on immigration, and the reliance, I guess you'd say, of China on an export model that's sure to run into massive political opposition no matter who wins the election. So when I look at everything, I think 2% for the Fed on an inflation goal is just a pipe dream. The market on the break-evens will eventually adjust to that, and we'll have to add some term premium as well to the 10-year. All these things really don't argue for the over-exuberance that we see today. I would say that 5,000 would be a temporary floor, but upside would be limited after that.
Finally, your inflationary concerns. You're not going so far as to call for, say, a double top on CPI or something that echoes the 70s.
No, it's definitely not the 70s. However, the Fed is talking about 2%, but the floor now looks like what was the ceiling in the 20 years pre-COVID for inflation. And that's a launching point for a higher move later with a stronger economy in the mid-20s. So if the Fed ever gives up, and they sure should give up on this 2% goal, it's a pipe dream, then the market would have to adjust. We might even add, like I said, some term premium into the market in addition to expecting long-term yields to be higher. Remember, long-term yields really should approximate the nominal GDP of the economy. If the economy can grow at 2% and inflation is 2.5%, then short-term rates should certainly be 4%. Futures is closer to 3% in 25. These are not settings that are maintainable, and therefore PE ratios should come down over time.